The Bank of Canada released its key lending rate decision yesterday. It talked about leaving interest rates where they were and continuing with their bond buying program and quantitative easing. And today, Tiff Macklem gave a speech that outlined in the most clear context their plan moving forward with respect to when they're going to increase interest rates and what the plan is for the future. And that's what we're going to talk about today. We're going to dissect the speech. We're going to go through the conversation that he had and what it means for us with respect to interest rates going forward and exactly how they're going to unravel this whole thing. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about that race to 25,000 subscribers. Yes, when we hit 25,000 subscribers, we are going to give away $5,000. Thank you so much to each and every one of you who has already subscribed. I appreciate you. If you haven't already, do me that favor, hit that subscribe button. It's free, it's easy, and if you win that $5,000, it's definitely going to be worth it. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's discuss Tiff Macklem's speech and probably the most clear forward guidance that we have received from the Bank of Canada yet. In fact, they have basically started this campaign of openness with respect to exactly how they're going to do things so that Canadians can, with confidence, know exactly how they can borrow and basically know what is going to happen as they start to unravel the quantitative easing and start to raise interest rates. So it's been really refreshing seeing a central bank act in this manner, be clear and concise, because if you remember back to 2008, 2009, when the financial meltdown happened, the years that followed were very much a series of years where there wasn't a lot of information with respect to the plans with regards to monetary policy. This was especially true in the US, and it led to a whole bunch of problems. So different approach this time around, which we can really appreciate. So I'm going to go into great depth here and discuss exactly what Tiff has said and exactly what that means for you going forward. But let's talk about what happened yesterday, because what happened yesterday was a whole heck of a lot of nothing as expected. Because of the negative GDP numbers, they weren't able to scale back their quantitative easing or their bond buying as was previously expected. It's now expected that they're going to do that one more time in October. And the speech that Tiff gave yesterday talks quite considerably about how they're going to do that and what it means with respect to the economy going forward, and the fact that they aren't going to reduce their bond assets until they make at least one rate hike. So I'll talk about what that means in a few minutes. But what's really interesting here is that they've basically given us the game plan going forward. Now, there's a couple things you have to take note of here. They talk a lot about the pandemic. They talk a lot about uncertainty with new variants. They talk a lot about the failure of the economy to grow at the rate that was expected. And a lot of this leads to uncertainty with respect to the July plan, which was essentially to start raising interest rates at the end of 2022. And those numbers and those dates and everything else could be pushed back either slightly or substantially based on what happens in the economy going forward. And if we see slow growth, as we saw in the second quarter of 2021, and if we see inflation start to come down considerably, or if we see a failure of jobs to get reintroduced into the economy, then all of those things could lead to a longer time frame with respect to rising interest rates. And one thing to keep in mind is that when interest rates get this low because of massive things that have happened in the economy and had a negative impact, there is a tendency for things to take longer to happen than is expected. It's like when you personally decide that you're going to start paying off your debt or you're going to save and try to hit a savings goal. It tends to not happen as fast as you think it's going to, because we obviously have a tendency to predict and hope and set goals that are considerably more optimistic than what is reasonable. So that is human tendency, and I'm going to suggest that there's a high likelihood that we probably aren't going to see interest rates rise until 2023, especially if the United States takes until 2023 before they make their first move. So this is, I think, a long-term play with respect to rising interest rates, and you'll see that some of the conversation, some of the context provided in Tiff's speech kind of lends to that idea that we may be into this a little bit longer than expected. So let's jump into it. I'm going to show you some quotes. Yes, there's going to be a lot of words on the screen, and I'm going to give you basically the non-economist terms of what this all means. So first and foremost, Tiff starts his speech with this statement, which is, we are moving closer to a time when continuing to add stimulus through quantitative easing will no longer be necessary. In other words, there's going to be less bond buying going forward. And we are not there yet. And that timing is a monetary policy decision that will depend on economic developments. Economic developments means, what does growth look like? What do jobs look like? And what does this pandemic look like going into 2022? Because here's what we're learning. We're learning that the vaccines, yes, they slow down spread, but not substantially. We're learning that masks slow down spread, but not substantially. What we're learning is that the thing that slows down the spread of COVID is lockdowns and not having people go out and be face-to-face with each other in confined small areas. So as we enter the winter, we may see more lockdowns, which means it may prolong the amount of time it takes for the economy to come back to full steam, because we may not be going back and doing all the things we thought we were going to do this winter, like going to hockey games and whatnot, if it continues to go down the road that it's going down with respect to the number of rising cases. Now, moving on to his next statement, and these are my highlights, by the way. These are things that I've pulled out of his speech that I thought were important. To keep our holdings of bonds relatively stable, we will need to purchase enough bonds to replace those that are maturing. Essentially, we will be reinvesting the proceeds of maturities, so we call this the reinvestment phase. So what this is saying is that in October, if and when they reduce their bond buying program from $2 billion to $1 billion per week, at that point, what they're going to do is they're going to continue to replace the bonds that are coming up for maturity and buying new bonds. And what that is going to do is it isn't going to be increasing the amount of stimulus in the economy, but it's going to be maintaining the excess stimulus that they put into the economy in order to bring it back to full steam. So they're going to continue to create some stimulus and continue to maintain the stimulus by continuing to replace the bonds. And they're calling this the reinvestment stage, which you'll see a little bit later on. They're going to talk about quite a bit. Now, this is an interesting one. We expected growth to moderate in the second quarter as Canadians grappled with the third wave of the virus. So they expected it to moderate. Did they expect it to go to negative 1%? No, they expected it to go down to about 2.5%. It obviously moderated considerably more than that, which has an impact on forward-looking statements. But the slowdown was more pronounced than we anticipated, right? So one thing that we need to be clear about here is they're going to make more statements in October. They're going to revise their outlook in October. But during an election campaign, typically central banks try to say very little in order to not determine or influence the outcome of the elections. So it's going to be interesting to see what they say come October. But really what's clear here is that the economy isn't moving at anywhere close to the pace they expected it to when they made their forward-looking statements in July. And I expect that in October, those forward-looking statements are going to change again. And they may even say we're not going to increase interest rates until 2023. Now, unevenness in the labor market is moderating, but considerable slack remains, and some groups are still being disproportionately affected, particularly low-wage workers. So this is going to become a very central theme of monetary policy throughout the globe, because while inflation is a key piece, they want to make sure that they get the economy going back to full steam so that jobs are reintegrated into the economy, and that people like low-wage workers aren't going to be left out in the cold. So this is why you're going to see them attempt to run inflation a little bit hot for a couple of years in order to make sure that GDP comes back up and that people are being able to go back to work successfully. Now, achieving full employment is essential to a complete recovery and sustainably achieving our 2% inflation target. That's why it is critical that we understand how Canada's labor market is recovering. So if you see high inflation, if you see high GDP, but you see low jobs, you can expect that they're going to continue to leave some quantitative easing in the system. They're going to continue to reinvest and continue to buy bonds, and the chances of an interest rate increase are going to go down considerably. Now, this is where it gets really interesting, okay? This is the clearest guidance we've seen out of the Bank of Canada of what's going to happen and when. Eventually, when we need to reduce the amount of monetary stimulus, you can expect us to begin by raising our policy interest rate. So as soon as they get to the reinvestment stage, then they may look at raising their interest rate, before they start selling off their bonds and reducing their assets. What this all means is it is reasonable to expect that when we reach the reinvestment phase, we will remain there for a period of time, at least until we've raised the policy interest rates. So once they hit the reinvestment stage, once they stop buying excess bonds, then that is the point where the next move will be to increase interest rates. And then it'll become a matter of watching and trying to figure out when exactly they are going to do that. Based on the maturity structure of our total holdings of Government of Canada bonds, reinvesting maturing bonds will require purchases ranging around $1 billion a week on average. So when they pare back from $2 billion of bond buying to $1 billion, that's how you'll know that they're in the reinvestment stage. And that looks to be like it will be October, maybe November, maybe December. Now, this is the last and I think probably the most important piece of the entire speech. Eventually, the reinvestment phase will end, and we will stop purchasing bonds to replace the ones that are maturing. So our holdings of Government of Canada bonds will start to decline. But as I mentioned above, it is reasonable to expect that when we do eventually need to reduce monetary stimulus, our first move will be to raise the target rate for the overnight rate, our policy interest rate. So here's how this all plays out. Let me make this real simple, real clear. Here's what happens next. At some point, they reduce their bond buying from $2 billion to $1 billion, probably soon. Then they're going to do everything they can to hold and maintain that bond buying program for probably close to a year, at least 9 months. And if everything is going great, end of 2022, they're probably going to increase interest rates. Now, if everything isn't going great, they're going to have to do one or two things. They're either going to have to push back when they are going to increase their interest rate, or they're going to have to start buying more bonds in excess of that $1 billion per week, or they may have to do both. But that all depends on how fast GDP grows. It all depends on what inflation looks like when the numbers start to be less transitory and more reliable. And it depends on what happens with COVID and whether or not we're getting locked down for longer periods of time this winter, which I hate to be the bearer of bad news, but I suspect is probably going to be the case in at least some jurisdictions across Canada as they try to bring the numbers down so that hospitals aren't overwhelmed. So what does this all mean for interest rates? What it means is we need to continue with our variable rate strategies. We need to be making sure that we are watching interest rates and that we're paying attention to what the Bank of Canada is saying. They have been clear that they are going to be transparent, so we can pretty much rely on the fact that they will give us an indication that interest rates are going to go up. Then we have to start looking at individual strategies, and there's going to be people who are going to be wanting to lock in. There's going to be people who want to maintain a variable rate strategy. For myself, for our family, we're probably going to maintain variable rate strategies because we know that when they start increasing interest rates, central banks have a tendency to overshoot and then they have to bring them back down. And long term, it's a better strategy, but it's going to come down to each individual's own situation. If you're a Mortgage 360 client, we'll take care of having the conversation with you and providing guidance. If not, I hope you have a great broker or a great banker who can help you make that decision for you and make it in a smart and intelligent way, not just based on panicking and going lock in, lock in, lock in. Remember, bankers have an incentive to encourage you to lock in, because as soon as you lock in, you're paying a slightly higher interest rate and you're paying significantly bigger penalties to get out of it. So keep that in mind. If you're looking to get into the mortgage market and you're just trying to figure out what to do, we have a course called Secrets to Getting the Lowest Interest Rate. It talks about how to get the lowest interest rate, where to find it. It also talks about the downfalls, the pitfalls, the landmines, the surprises that come along with getting the lowest interest rate. It talks about how to negotiate with your banker, with your broker, all the things you need to know to be fully informed and be able to have a conversation about interest rates. We've priced that course so low that it is available and easily accessible to anybody who is going to or planning to get a mortgage. The reason why we do that is because we realize not everybody can get their mortgage through Mortgage 360. So we want to make sure that everybody has the ability to get the information that our clients get, and we do it through that course. There's a 50% off discount coupon that will be going away at some point in the description below. And if you would like us to help you on that journey, we're more than happy to help you through our company. Or if you just want the information, go ahead, click that link in the description below, throw that discount code in there and get a really good deal that will save you at least 10 to 50 times your money back. And we've guaranteed that it'll get you at least 10 times your money back by putting in a special offer from Mortgage 360 to do just that. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one. Cheers.